Hey everyone, welcome to The Explainer. If you're joining us, it means you probably like to cut through the noise and get straight to the facts. And that is exactly what we're going to do today. We're embarking on a data-driven journey into Bhutan's latest Q3 macroeconomic update. We're going to look at exactly how a resource-dependent economy navigates some truly intense global shocks, what the recent trends are telling us right now, and most importantly, what the financial horizon looks like for the next 2 to 4 quarters. It's a fascinating balancing act between external pressures and domestic strategy. So let's just jump right in.
Okay, look at this massive, honestly almost unbelievable statistic that we have to start with. How does a small, developing economy survive a historic 157% weighted average surge in fuel prices? Because of conflicts in West Asia and all those cascading supply chain disruptions, Bhutan experienced the largest fuel price shock to its economy on record. I mean, that's the kind of external pressure that can completely paralyze a nation's growth. To understand how they absorb this and what it means for the coming months, we have to look at the numbers.
Okay, let's dive into this. Section 1. Navigating global economic headwinds. So when you have global supply chain disruptions of this magnitude, the ripples are felt across every single sector. The crucial point here is that the economy is still growing, which is definitely good news, but the momentum has slightly shifted. The 2025 growth projection was recently revised downward to 8.01%, down from a previous estimate of 8.71%. You might be wondering why the drop. Well, aside from the global headwinds, it really comes down to domestic production, specifically weaker than anticipated electricity generation. While the electricity sector is still estimated to grow by a solid 15%, previous models assumed a much higher 26% growth. Let's look closer at why that matters, especially when fuel costs are absolutely skyrocketing at the same time.
Which brings us to Section 2, the fuel and inflation shock.
This is the most pressing, immediate threat, right? How a massive fuel shock filters down into everyday inflation. A shock like this can completely derail household incomes. But look at this stark contrast. If we take away government intervention, inflation from March through May could have violently spiked to around 17%, but instead it's expected to remain below 8%. How on earth did they do that? Well, through a mechanism called the National Fuel Price Smoothing Framework, or NFPSF. This policy stepped in and actively suppressed a potential economic disaster by absorbing a massive portion of that 157% fuel shock long before it ever hit the consumer. Now, what's really interesting about this slide is the massive visual gap between these two trajectories. If you look at that red dashed line, you are seeing the terrifying trajectory of inflation without the fuel price support, climbing steeply past 16 and 17%. Yikes! But then look at the black solid line. That's the actual trajectory with the support in place, holding steady closer to 6 and 7%. The empty space between those two lines, that represents the exact amount of economic pain absorbed by the government to keep household incomes intact and transport costs manageable. It's just a striking visual of policy in action.
Moving right along to Section 3, hydropower and tourism trends.
So we know the defense mechanisms are working, but what about the actual engines of growth? Looking at their recent Q3 performance, there's a fascinating split here. On the right, tourism is a massive bright spot. Tourist arrivals saw a robust 56.89% increase compared to the previous year, showing really strong post-pandemic recovery, even though they do expect a slight dip in Q4 due to global tensions. But on the left, you'll see the vulnerability of hydropower. During the winter months in Q3, production significantly dropped to about 20% of peak capacity. Lower water levels simply mean lower electricity generation, and that directly ties back to that downward growth revision we talked about earlier.
But here is where the forward momentum kicks in. Think of this as the monsoon engine. With the onset of the monsoon in March, output naturally accelerates. The target jumps up to 3,655 gigawatt-hours in Q4, and it looks to hit a massive full generation of 7,462 gigawatt-hours by Q1 of the next fiscal year. Just as the rain replenishes the rivers, the monsoon essentially replenishes the national treasury. This seasonal surge is exactly what the economy relies on to balance the books over the next 2 quarters.
Let's shift focus to Section 4, trade, liquidity, and debt.
Looking at the underlying financial mechanics, one of the most striking findings in the Q3 update is just the sheer amount of cash sitting in the system. There was a 46% surge in liquidity from Q2 to Q3, bringing the position to over 32,000 million new Gultrum. Why the sudden influx? It's driven primarily by net foreign assets, increased hydropower inflows, and Indian rupee swap arrangements. Now, having a lot of cash sounds great, but the report explicitly cautions that such high levels of excess liquidity require incredibly careful management. If it's not absorbed or directed properly, it can actually cause external imbalances and widen the trade deficit as imports rise.
Speaking of the broader financial picture, total public debt slightly decreased from 110.5% in Q2 to 107.8% of GDP in Q3. Now, while a decrease looks super positive on the surface, the report clarifies this was largely due to a reclassification of debt coverage, basically removing publicly guaranteed debt to align with reporting standards, rather than a structural paydown of the core debt. In fact, looking ahead, the medium-term outlook shows a definitive upward trend, driven heavily by external borrowing to finance those massive hydropower and infrastructure projects. Which brings us to our final segment, Section 5, Outlook for Next 4 Quarters.
We've analyzed the current data, so let's move to and see how this builds our horizon roadmap for the next 2 to 4 quarters. In the very near term, Q4, we see that monsoon onset accelerating hydro. Moving into Q1 of the next fiscal year, we really hit that full hydro generation stride. But look at the end of the timeline here. For the entirety of fiscal year 26-27, the fiscal deficit is actually projected to widen to 6.54% of GDP. Why? Because Bhutan is entering the peak phase of its 13th five-year plan. Major capital expenditure on infrastructure projects is going to accelerate significantly, pushing expenditure way up and widening that deficit before it narrows again in the outer years.
And keep in mind, that massive spending is happening against a backdrop of those continued global headwinds. Because supply chain disruptions and volatile fuel prices are expected to persist, the near-term economic growth outlook for the entire year of 2026 has been lowered to 6.31%. It's a calculated slowdown, honestly. The expectation is that by weathering the storm right now and continuing to invest in domestic capacity, the economy will experience a spillover effect and eventually rebound to a much stronger 7.61% growth in 2027.
Which brings us to the ultimate question we have to ask after analyzing all these projections. Will Bhutan's strategic external borrowing for long-term hydropower infrastructure ultimately outpace the immediate drag of these global economic headwinds? The data shows an economy actively buffering itself against historic external shocks, all while doubling down on its domestic power engines. It's a really high-stakes balance of managing debt and liquidity today to secure growth for tomorrow. It definitely leaves us eager to see what the next quarter's data will reveal. Thank you so much for joining me for this explainer, and as always, keep questioning the data.